I'm Mary Tess with the Moving Friends 4 group. I've got my co-host Tyson here with me today, and our special guest, our accountant, Jimmy Tang.
Good morning.
Yes.
That's
Jimmy.
right, because we're here to talk about death and taxes.
Woo.
And more of the taxes.
Yeah, more taxes then.
Yeah.
We'll probably do another podcast episode on death.
Probably. I don't know. It's
going to be morbid.
Sad.
I don't know.
That's what it's going to be. But Jimmy, we're so glad that you can join us today and
thanks
be
for having
part
me.
of this. It's great. And the question, like a lot of people are tuning in, don't know who you are, so why don't you tell us a little bit about yourself, what you do?
Yeah, thanks. I run an accounting practice here in Burnaby. We specialize in working with small business corporations, but with a heavy leaning towards real estate sector. So that's why we get along so well, right?
Mm-hmm.
You know, and so everything from the nitty-gritty bookkeeping work right through to tax compliance. Which of course ties into your death and taxes, right?
Right.
Yeah.
Yeah, I think we originally found you through doing some just Googling. I was like, I need to become a PREC, and I went onto some realtor forums, and I was like, who does everybody use? And everyone's like, Jimmy Tang, Jimmy Tang. I was like, I like his name. I'm gonna give him a call.
Yeah.
Oh, thank you.
You
Yeah.
got the JLT.
That's
yeah,
right.
you know me. Like, singing like this.
Oh, we can do a rap video sometime.
Okay, that'd be sweet. That'll be the next podcast. Let's do that. And
Okay, so we want to start with give us some like hot gossip on somebody who's had like a really nasty real estate tax related story. Somebody that got dinged with something, didn't know about something. Like,
feel free to use names.
Yeah, we will tag them.
Except for us. Don't use any.
Don't
Okay,
not
all
our
right.
stories. But.
So as you know, in the past couple of years, you know, the government's been rolling out a bunch of COVID benefits. So the federal government is really looking for money. And the Canada Revenue Agency is the ultimate collector of money for the government. Mm-hmm. So recently, they've been really ramping up audit activities, everything from, and real estate related too, so GST issues on real estate, capital gains issues, they're hitting a lot of stuff. So for example, I've got one where the CRA is looking at whether a transaction was taxable for GST, right? So a client had bought a property. It was a tear down property, so they tore it down, built it back up again, and just by chance they were walking around in their neighborhood and they found another property halfway down the block that best way to describe it was they said they just liked the feng shui. I don't know if you guys know what that is, but the vibe or whatever it was about this particular property, and there was something about their property that didn't feel right, and they weren't able to pinpoint it. So at the end of the day, what ultimately happened is they sold their property that they had just newly built, moved into the next one, and 3 years later were subject to a GST audit. So that 3 years was actually just quite recently, right? So the end result of that was we had to launch a defense. We had to tell the whole story about why they bought it, what they didn't like about it, why they sold it, what they liked about the new place, etc. And it was a pretty hefty bill. It was the $4 million sale price was the sale of their old home,
5%
which really was just
$4
new.
million.
Yeah, so 5% of $4 million is, I mean, my math is terrible sometimes, but I think it's $400,000, right?
Oh my
Yeah.
goodness.
Wow.
I mean, I don't know about you, but I'm getting sweaty just like, when you
So,
say
you know,
audits are happening 3 years later, they're getting dinged with
Yeah,
taxes.
yeah.
Oh.
Well, the statute bar period is normally 3 years. For real estate transactions, it's actually there's not a statute barred limited period for real estate transactions, but
There isn't.
It usually, there isn't, right?
Okay.
So the government usually takes about 3 years before it kind of goes through the regular channels for them to review things. So that was a particular story that really caught my attention. I had to work in hand with a law firm in Vancouver, like one of the premier tax law firms. Ultimately, though, we did win. Right, but it cost the client a bunch of money.
Yes,
tens of thousands of dollars to fight that. But ultimately, what was at stake was $400,000.
No kidding.
oh my goodness.
Right? Yeah. So there's no statute of limitations when it comes to tax stuff.
Well,
like
sorry,
7 years,
the general statute of limitations is 3 years, but when we're talking about real estate transactions, that limitation isn't
So
there.
we will forever be holding our breath.
Okay.
Capital gains and whatnot as
Write
well.
everything down. That's what you're saying. Like keep all receipts, all that sort of stuff. That's great. So investors often we'll talk about capital loss because in BC, if you have like an investment property, and we want to shift to investments a little bit, a lot of, like, it's hard to cash flow a property in the Lower Mainland if you own investment property. So can you just like share with us what's the benefit? Because we hear people talking about capital losses and how they're not necessarily a bad thing, but I know for us, like anytime we hear the word loss, it's not always a great thing.
Yeah.
Hence why we're going to talk about death in a couple. No, I'm kidding. But can you just like unpack what's the benefit of capital loss and how does that work in the whole grand scheme of?
Yeah. I mean, obviously, nobody ever wants to lose money. But sometimes your investments are just never going to recover. That might be applicable to real estate property as well too. Definitely more so with stocks and securities in the open market. So where you have capital losses is it's great because you can use that to deduct against your capital gains, but only deduct against capital gains. Otherwise, you either carry it backwards 3 years to apply against capital gains, or you carry it forward and apply it against future capital gains. So where the capital losses are really useful is in a year where you have a large capital gain. Like let's say, for example, you sell a rental property, you have a large capital gain, and because it's a rental property, there's no principal residence exemption, or you might have a really good year in the stock market where you have a bunch of capital gains. The only way you can reduce a capital gain is by having a capital loss. So if in your portfolio you have, just really terrible investments that you've been hanging on to for a while, hoping that they're going to recover, and there's really not a chance of them recovering, maybe that might be the year that you let it go. So whatever capital losses you have that are on paper, you then trigger that capital loss, you realize it, and then you can apply that capital loss against your capital gains.
So it's kind of like dollar for dollar in a way that it's, if you have $50,000 losses, let's say in the stock market, because stocks have been getting hit hard, the last year or so. But then let's say you made $100,000 on a property and you sell that. So then would you only be, then the capital gain would only be $50,000?
Yeah. Yeah.
Okay.
So to the extent that you've triggered that capital loss and you've sold those investments, then you can take those capital losses and apply it against your capital gains.
How about rental losses? How does rental losses work? Because like I know there's been a lot of people who have bought property and they've either leveraged like a HELOC on it or that kind of thing. But then now the interest rates have gone up.
Yeah.
Their payments have gone up, exponentially. So now they're probably upside down on it. Is there an incentive or is there an advantage in that at all? Or like, does it drop your income tax or?
Advantage. I wouldn't really call it an advantage because it still sucks to lose money, right?
Give us some hope, Jimmy.
It still sucks to lose money.
Silver lining?
But ultimately, when it comes to rental income or rental losses, if you own that property in your personal capacity, then the rental loss would then be deducted against other sources of income that you have in your tax return. Okay. So the most common scenario that you'll have is your clients would be maybe employees, so they'll got T4 income, and then they have an investment property. If they turn a loss on that investment property, that loss will be applied against their other sources of income, including employment income. So ultimately, their taxable income gets reduced as a result of this rental loss, which reduces their tax base and ultimately results in less income taxes.
Right. And you can't pit that, on one spouse that makes more than the other. It's evenly distributed between the two if they're both on title.
Yeah, it depends. I mean, ultimately, the assumption is that if you've got a marital asset, it's an even split between the two of them. There are certain circumstances where you might have the property split one way, like maybe more or less to a particular spouse, but there's usually some basis for that split, though.
Cool. See, this is why he's our accountant, because my eyes are a little glazing over, and this is not a personal offense, but this is, that's great.
That's
very helpful.
I don't sell houses.
There you go. Okay, can you tell us about anti-flipping tax? Because people are like, let's flip this property, let's make a profit, but now there's a little bit of a tax to that.
Yeah. So the anti-flipping tax it's not a new tax. It's a change in the way that the Canada Revenue Agency will treat that income or loss, right? Though there's a change in the way they're going to treat it, right? So the anti-flipping tax, it's a deemed disposition with respect to how they're going to tax it. So they're going to treat it as business income, right? So normally when you sell a property, you have a capital gain, usually. You might have a capital loss.
Hopefully,
right?
that's it.
Hopefully a capital gain.
If I've done a good job.
If you have a capital gain, then that capital gain goes on to your income tax return. Half of that capital gain will be subject to income taxes, And if that property is also your principal residence and you designate it as your principal residence, generally you don't pay income taxes on the capital gain. So there's a full waiver of the income tax, right? So in the best case scenario, no income taxes at all because of your principal residence exemption. Next level up from that is you would only pay taxes on half of the capital gain because it's an investment asset for you. Okay.
Right.
The anti-flipping tax turns everything upside down and deems that transaction to be on account of business income. Okay. So if you have a
it's
capital
all
gain,
taxable.
it's all subject to tax. Okay.
Wow.
Likewise, if you have a loss, the CRA deems that loss to be non-deductible. All right. So you don't get to recognize the loss either in an event where the anti-flipping tax applies. Okay. So in business income, 100% of your profit margin, your capital gain, whatever you want to call it, is subject to tax. So if you're already earning $100,000 of income through employment or whatever, and let's say you have a $200,000 profit margin on the sale of your property, that's going to be all taxable on your tax return. Now your taxable income is 200 plus the 1 is 300.
Ooh.
Okay.
Yeah.
It applies on residential property. It applies on properties where you had bought and sold within 12 months, right? So there's a hard date there, but there are some exemptions to that. So the most common ones would be if there's a death or illness in the family, if there's a relocation for job, for example. There's a whole list. So your viewers, I would advise that they take a look at that list to see if they fall into that. But things like you change your mind about the location, I don't think it's on the list, right? You don't like the property ultimately, don't think that's on the list either. Maybe the property's too small for you, don't think that's on the list, right? So you got to be really careful when you have a client who you'd help to buy something and then within 12 months they're now looking to you to sell it. That anti-flipping tax might apply.
So we'll add that to our checklist. Be like, are you sure?
Yeah.
Are you sure?
Are you sure?
Double sure.
Yeah.
Yeah. So you can just fire me if anything, if we have a property or something, or
To avoid anti-flipping tax.
Yeah, I'm pretty sure. Now we just incriminate ourselves.
This is
on,
why we're not accountants,
No.
because we have really bad tax advice for people. You probably have to give people a lot of bad advice. Do you have any? How do you deal with that? Because you're probably handing out some big tax bills to people.
bad advice,
yeah.
bad news.
Some
Bad
people
news?
don't
Yeah.
Not bad
prepare.
advice.
Oh,
bad
yeah,
advice
yeah.
of people that I'd be giving him.
Right, bad news.
Bad
Yeah,
news.
bad news. Yeah.
Oh, I'm not always the most favorite person in the room. Sometimes it is what it is, and clients think that accountants, we have like a magic wand or something. We
Right.
don't,
Yeah.
right?
Make it disappear.
Can't make it disappear. We can definitely try to minimize it. We can,
Right.
mitigate your risk
Yeah.
in terms of a risk for a reassessment, a risk for an audit. We can counsel you on the level of risk of a particular transaction that you are engaged in. Oftentimes, income tax is left to interpretation. There's a lot of subjectiveness to it. And we live in a tax system where it's honor-based. So you file your tax return the way that you feel fits your circumstances. And it's based on a secondary review, whether you end up paying more or less. So yeah, handing out bad news is part of the gig.
Yeah. We kind of have a love-hate relationship with you.
I know sometimes mostly you love me though, right?
Mostly.
Yeah.
That's great.
And then we get off the call, we're like, oh no. Okay. Let's talk about first-time home buyers. So we get a lot of first-time home buyers asking us, like, what are the benefits of being a first-time home buyer? Is there some exemptions for them?
Yeah, so the nice thing about being a first-time home buyers is there's usually an exemption on their property transfer tax. So there are conditions that apply, right? There's conditions with respect to what the top level purchase price would be. The buyer must also meet certain conditions, so obviously they have to be a first-time home buyer. And first-time home buyers defined a little bit differently for different programs. So, for example, the RRSP first-time home buyers withdrawal, you just have to have not owned a home in the last, I think it's 5 years, right?
So you own a home for 5 years, you can tap into your RSPs then to
Yeah, so if you haven't owned a property in the
Yeah.
last 5 years, you or your partner, whoever's on title with you, right?
Okay.
Then you could still withdraw under the home buyer's plan. Whereas the property transfer tax exemption is like you could not have owned any property at all ever, right?
What about anywhere in the world? Like what if they own
I believe
something
it. I
in a different
believe it
country?
also includes anywhere in the world for the property transfer tax exemption, right?
Okay.
There's GST rebates as well. Not necessarily. I think that one's not necessarily for first-time home buyers, but just new residential
buy brand
property.
new, yeah.
There's also now the first-time home buyers tax-free savings account. It's a really long name. That was announced a couple of months ago too. But the point is, you can contribute to effectively what is similar to an RRSP, but it's a tax-free savings account. The contributions are tax deductible. The money will accumulate tax-free. When you draw the money out, it comes out tax-free. And the biggest difference between that versus the traditional RRSP account is that you don't have to repay it.
Yeah, because RRSP, you have, 25 years to repay?
I think it's 15, maybe
15?
20. Yeah, I think it's 15. Yeah. But the RSP home buyers plan, you do have to repay.
Right.
So out of your future income, you're putting that money back in. And if you don't include that RSP contribution each year, that portion of what you should have contributed just gets added to your income for that year.
Okay.
Yeah.
For that year. Could you have a spouse? So with the property transfer tax exemption, could you have one spouse on title, and then when you go for another property, or like you buy buy a secondary property, can then the other spouse claim that same exemption? Or
that's a good question. I might have to get back to you on that answer. I can't recall, and what's holding me up from an answer is I can't recall if that exemption is based on a prorated basis on your proportion of ownership, or if it's based on the family unit being, the two spouses, for example, right?
Right.
Yeah.
Yeah, and I think that is also a legal question too, because we've had some clients do that where they have one spouse like 1% on title, and then that way when they go to sell it, like for example, I think our dad was on one of our properties when we first bought our
first
together.
property, 1%.
And so then when we went to sell it, he had to pay capital gains, but just on his 1%.
Yeah.
So there are ways around it, but that would be a consulting fee, not a free podcast fee.
Yeah, and if you have clients who are buying and they're splitting the ownership like that, from an income tax perspective, you got to be really careful about what is the basis upon which that split is determined, right? Is it based on contribution of capital? Where that money come from? Because if you're just kind of arbitrarily splitting that, and it looks like you're maybe allocating more of the ownership towards the lower income earning spouse, the Canada Revenue Agency might look at that and look at it as a tax avoidance scheme. Right, and then they'll reassess something different anyways.
Oh man, Jimmy makes me so nervous.
Just play by the rules. That's
okay.
Yeah, we'll play within the rules. Sometimes we'll bend them a little bit, but we won't break them. Just play within them.
Yeah.
Right?
Okay. Gamble.
Yeah.
Okay, so I get a lot of realtors that also ask me, when's a good time to PREC? Because I became a PREC with Jimmy's help. And so is there a certain income that a realtor should hit before they become a PREC? What are the benefits of a PREC? Can you pay your kids out from that?
Yeah. Oh man, I got a whole 30-minute slide deck show on that alone. But
that's true.
When it comes to a PREC, from my perspective, it's primarily income tax benefits. What's the tax benefit, right? And mostly it's a tax deferral benefit. Income taxes that you would normally pay as a sole proprietorship realtor, you would defer some of those income taxes to the extent that you leave your net profits inside the PREC, and that you just pay the 11% corporate tax rate. So the tax deferral is one of the biggest benefits. Then there's the outright tax savings, where you might be able to split income with your spouse or with your adult children. So those tax strategies would result in an outright tax savings. Okay, and if you don't derive a benefit on the tax deferral side or the tax savings side, then in my view, there's not really much of a benefit to becoming a PREC. So let's focus our discussion on those two things, the tax deferral and the tax savings. So in order to yield a tax deferral benefit, you got to leave money in the PREC, right? So in other words, your lifestyle is not so expensive that even after your business expenses, you draw the rest of your income out to pay for your personal expenses, okay? And really what that means is leaving money in the PREC to the extent that you don't need it for your personal expenses. So one indicator I like to have people think about is, what is your net savings at the end of the year, Okay, net savings meaning business expenses
Yeah.
minus your personal expenses, what's left over, at the end of the year. The larger that number is, the more likely it is that you'll benefit from a tax deferral. Okay, that's very different than looking at it from a top line gross commission income level, because you could have $1 million in gross commission income, but if you end up spending all of that, if you spend all $1 million, you're not going to have a tax deferral benefit. Okay, the tax savings benefit is where you have opportunities to split income with your spouse. Like you would be a great example of that.
Because you used to be able to do that, but then that's been taken away. From most.
I won't say it was taken away entirely, but it's been heavily restricted in the sense that, so what we're talking about here is tax on split income.
Right.
And tax on split income used to only apply on minor children. So where your minor children are shareholders of your PREC, any dividends paid to them would be taxed at the highest marginal tax rate. So you wouldn't do it. Right?
Yeah.
But if you have a spouse as a shareholder, adult children as a shareholder, you could pay them dividends at your discretion.
Yeah.
Okay. And then a couple of years ago, when the CRA had expanded the definition of tax on split income, it applied to all Canadian residents. So not just your minor children, but also your spouse. So in order for your spouse to receive dividends from your corporation, they must meet certain criteria. Like, for example, they must work with you in your PREC, for example, right?
Drive you around.
You got to do something for a married tax.
I do.
Yeah, you have to do.
You got to do something now. You got to earn it, right?
But she has to pay me.
You have to earn it.
Yeah, she can pay you by dividends.
Yeah, but you have to pay me.
Right? And if you if you get paid by dividends, but you are doing something for the business, and there's more of a detailed test in there, but for argument's sake, as long as you're doing something for the business, you meet that criteria, the tax on split income rules don't apply to you. So you can still pay yourself by way of dividends at your discretion. Right? So splitting opportunities, so if you're able to split income with your spouse, that means if you had drawn out $300,000 for your own personal use, the taxes overall would be less if you could split that between two people versus having one person pay the entire taxes on $300,000. So splitting that income results in lower taxes overall because you're utilizing the tax brackets of both spouses and adult children too, right? And that results in a tax savings. Right? So those two are the primary reasons why somebody will want to PREC. And then if going back to how do you know when to PREC? Well, if you have a savings account at the end of the year and there's a pretty hefty balance in there, that's probably an indicator you might be worthwhile having a PREC. If you have really high gross commission income, that's another indicator, but that doesn't look at your overall expenses. So again, just an indicator that if you have an extraordinary amount of high commission income, there's probably a good benefit for you. If you have a spouse that works with you in your business, then there's tax savings opportunities by splitting income. So that would be another indicator that becoming a PREC would be a good idea.
Okay.
And then you're limited to how you can invest that money in a PREC. But if you wanted to, you could also set up a side holding company or something like that at the same time. Have one that, and so you can funnel all those savings into there and invest it more in there's less parameters around it, right?
Yeah, what's the benefit of the holding company?
Yeah, absolutely. Great question. The PREC, it's limited in terms of how it can earn its income.
Like you can't buy property with it.
Yes, that's right. Well, the property that you can buy must be used for your business. So if you were to buy a commercial strata office that you use as the office for your PREC, that would be fine.
Okay.
Right? But you can't go and invest in real estate properties for the purposes of earning rental income. So that would be against the rules that are applicable to PRECs. So in light of those restrictions on how you can earn income, you've got all this cash that is accumulating inside your PREC. You want to do something with it. So if you don't have a holding company, then the only way to get that money out is by paying it to yourselves, which then triggers personal income taxes, whether it be dividends or payroll. It's additional personal income taxes for you. That results in reduced purchasing power with your net after-tax draw, right? If you have a holding company that's a shareholder of your PREC, you can pay dividends up to the holding company. Dividends from one corporation to another connected corporation are tax-free. And then you would have full purchasing power with that money. And you have an outlet, from PREC to your holding company, the money will flow. That way, your holding company is not a PREC. It is not subject to the same restrictions that your PREC are imposed upon, and then you can do whatever you want with the money. Right?
You can do whatever you want with the money.
You can do whatever you want.
That's all that I've taken out from
if you're going to spend it on
podcast.
personal things, then of course you got personal taxes as a result of that. But if you recycle your money inside your holding corporation,
right.
Stocks, bonds, mutual funds, for example, real estate properties earning rental income, you can invest in another business, right? So shares in another corporation that is earning active business income. So there's lots of things that you can do with the money. There's, if your holdco is earning investment income, there's a tax grind on the small business deduction limit for your PREC. That's another conversation, of course. But the point being is that there are some connecting pieces on the tax return for your PREC and your holdco when it's earning investment income. But overall, you have that outlet. Once the money's in the holdco, you do whatever you want with it.
Great. And for those who don't know what PREC is, stands for a
Personal Real Estate Corporation.
That's right.
When realtors incorporate to save taxes. When I call Jimmy, I'm like, hey, I made some money this year, finally.
How can I minimize my taxes?
Help me.
Right?
Yes.
Exactly. Okay, so now I've heard just a little bit about this, but can you just tell us a little bit more about the underused housing tax? What's that about?
Yeah, so that's new for this year.
Yeah.
And the underused housing tax is the federal government's version of the BC speculation tax. Okay. The BC speculation tax requires all property owners who own residential properties within specified regions to declare that they are citizens or not citizens or tax residents, and then they got to go through a whole questionnaire, and then either tax applies or doesn't apply. But if you're a property owner, you have to declare.
Yeah, if you own a house, you've most likely filled that out.
And everybody on title has to fill
Everybody
one out.
on title has to fill one out.
Yeah.
So the really nice thing about the BC speculation tax is that if it applies to you, you have to do something. Because if you own property, you're getting a letter in the mail.
Yeah.
Okay. The underused housing tax is primarily focused on foreign ownership of property, and the federal government doesn't tell you whether you need to do something or not.
So you might not know that you don't know.
You don't know what you don't know, and the late filing penalty or the failure to file penalty is $5,000 for individual owners.
Oh my goodness.
$10,000 for non-individual owners, so corporations, partnerships, etc.
But you may not know.
But you may not know.
So it's like the girlfriend in high school, you have to read her mind, whether she's if you're upset,
I was gonna say something, but I'm married.
Okay,
I don't know.
I can say it.
Yes. But
Really?
you don't know what you don't know, right? And you can get in trouble for not knowing what you don't know, but you should have known, right?
I'm drinking your water.
We all need a little bit of a water break now.
So anybody
That makes me nervous.
could in sense.
Yeah. So
Okay.
let's talk about what the UHT.
The UHT.
Yeah, how it's applied to people. So the UHT breaks it puts people into a bucket. And when I say people, I mean individuals, corporations, partnerships, etc. Okay, so it puts owners into two broad buckets of excluded owners and affected owners. Okay, so if you're part of the excluded owners group, you don't have to do anything at all. So it's as if the UHT doesn't even exist to you. Okay, so excluded owners includes Canadian citizens, Canadian permanent residences, and there's a few others on that list which I don't recall exactly, but I know Indigenous groups are in there. So Indigenous governments, corporations that are wholly owned by Indigenous governments are part of that group. Okay, and then again, there's some other people in there. But for the brevity of this conversation, we're talking about individuals mostly.
Yeah.
Right. So if you are a Canadian citizen or a permanent resident, you are part of the excluded owners group. You can celebrate. You don't have to do anything at all.
Don't have to read the government's mind.
Yeah, don't have to do anything.
We are good.
Yeah. So I want to emphasize that Canadian citizenship and permanent residency is an immigration status. It's not a tax residency status. So some taxes look at residency in terms of where do you file your income taxes, where do you consider to be your home. So for the purposes of the UHT, it doesn't look at what is your residency for income tax purposes. It looks at what is your residency for immigration purposes. So if you are a Canadian citizen or a permanent resident, but you're living abroad, tax doesn't apply to you. Okay?
Interesting.
So you could be in the Bahamas, own property here, leave it empty because you only come back here whenever you want to. You might be subject to the BC speculation tax.
Speculation tax will charge you. Yeah.
Right?
Yeah.
But you'd be exempt on the UHT. Right? So it's really important to understand
That's like my dream.
which tax looks at people in different lights.
Yeah.
Right? Okay. So let's talk about the affected owners group.
Okay.
So broadly speaking, if you're not an excluded owner, you could assume you're an affected owner, right? More specifically, there is a list on the Canada Revenue Agency's website, but it does say that this list is not exhaustive. It's just intended to give you a sense of who would be part of the affected owners group. So if you own property through a corporation, you're part of the affected owners group. If you own property through a partnership, you're part of the affected owners group. So think about all of your developers, all of your partnerships that own property that they're developing. Think about people who have holding corporations that own residential real estate. They're part of the affected owners group. And if you are part of the affected owners group, you have to file the UHT. So the UHT return, you have to file. Even if filing is only for the exercise of claiming the exemption.
Right.
You still have to file. Right. So now, if you are part of the affected owners group, then the process is very similar to like the BC speculation tax.
Yeah.
Because now you have to do something, right? Once you're in that return, there's a whole questionnaire. Does this apply to you? Does that apply to you? Blah 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 blah. And what that questionnaire is looking to do is determine whether or not you actually have to pay a tax. Okay? So there are exemptions for the UHT. So if you are occupying the property as your primary place of residence, you have an exemption available. Okay, and similar to the BC speculation tax, there is a bright line test in terms of I believe it's 6 months or more in the year you're occupying that property. So you don't have to be a tax resident of Canada, but if you are a foreign entity, so not a Canadian citizen, not a permanent resident, you're not even filing tax returns here in Canada, but you happen to be living in that property more than 6 months out of the year, that's an owner-occupied exemption. Okay?
Gotcha.
If you're renting out the property to somebody else who is arm's length to you, that's a tenant-occupied exemption. Okay. There are other exemptions such as property under development, and there's a whole list of them there. But again, if you're part of the affected owners group, you have to file the UHT return only to find out that you are exempt.
Yeah.
Okay.
So essentially, the whole premise behind the tax is to encourage, because we have such a supply shortage in housing, is to encourage those who are just like corporations or whatever foreign entities who are holding just onto vacant properties. It's incentivizing them to rent them out or to use them. Yeah.
So let's add up the taxes, shall we? All right. Yeah. We've got if you've got a Vancouver property, you have the BC speculation tax, which applies province-wide to specified areas.
Yeah.
If your property happens to be in Vancouver, you also have the Vancouver empty homes tax.
Right.
Oh, yeah.
And then now you've got the federal UHT. Let's add it up. All right. So the federal UHT is 1%.
Why is he smiling?
Oh, it's evil, isn't
sick.
it? I know. I'm a little twisted sometimes. You got the 1% on the UHT.
Yeah.
Okay.
I believe the empty Vancouver homes tax is 3%.
Yeah.
And then the BC speculation tax is 2%. Right.
That's on what? The
assessed value of the property.
Assessed value. Okay.
Yeah.
Yeah.
So that's my math is terrible sometimes, but I think that's 6%.
6%.
6%.
So if your house is $1 million, it's 6% of $1 million, or just
of the assessed value.
Assessed value. Okay.
Assessed value.
Yeah.
So $1 million assessed value, 6% of that. I think that works out to $60,000.
Yeesh.
I don't know.
Oh gosh.
Somebody do the math for me.
Yeah, it's something like that.
You know what they say about the CA designation? It's it stands for can't add.
It's true.
Should I be nervous? He's doing my job.
Yeah, I know. Okay, final question I have for you on this that we've just been wondering about is estate planning.
Yeah.
We have a few clients who are actually, we have some senior clients who are actually looking at the future and their property. A lot of them are sitting on a lower mortgage, but their property value has gone up a lot.
Yeah.
And so they're just wondering what's the best method or way to transfer that to their children without triggering some big taxes. Like some we've heard about setting up a trust, other ones we've
Family trust.
family trust or those kind of things. But what's in your mind is the best strategy for that? Or
Yeah, I mean that's
a huge
again
question.
that's another
That's a big
really
question.
really big topic that we
Yeah.
could probably talk on for a while about it. My general answer to estate planning is that, you know, if you have it within you to give that gift before you pass away, that's usually going to be the best result, right? You can avoid probate. You'll have certain exemptions available to you. And and of course, the most important part is that if you give that gift before you pass away, you get the enjoyment of seeing your beneficiaries, you know, spend that money or realize the benefit of your gift, right? And you know, you can't see that if you're dead, right? So give that gift before you pass away. But if that's not possible, you know, some are concerned about probate. So probate is a tax on the overall value of your estate, and your property is part of your estate. So if you don't have anybody else on title as a joint owner with right of survivorship, for example, then that goes into your estate. It's part of your probate taxes, right? If you have a portfolio of stocks, bonds, and whatever, that's all part of your estate as well too. So the probate tax can get hefty, right? Now, I'm not a probate lawyer or whatever, but you know, lawyers are really good in that regard too. And probate and estate planning is really also another subset specialty within, you know, accounting as well too. So there are accountants out there who specialize in estate planning, right? If you want to utilize a family trust, that does get expensive because you have to file a trust return every year. So as always, you have to weigh the benefit versus the costs. And usually when a family trust is in play, I often see that in terms of blended families, you know, people wanting to ensure that whatever assets arose, you know, in their previous marriage with their previous children, that goes back to them, for example. And then of course, with their new blended family, those assets go a certain way, right? So a family trust would really help to ensure that your wishes are carried out once you've passed on. Right? If you have people who are your beneficiaries but might not have the capacity to take care of themselves, right? Then a family trust will ensure that your wishes are carried out. The assets don't necessarily belong to the beneficiaries, but the assets are there for the benefit of the beneficiaries. So you'll need somebody as a trustee to carry out your wishes as well too. Right. So family trusts are really good for those types of scenarios, right?
So it really, it's really depends on your scenario of what you have.
Yeah, it definitely does depend on your scenario. But, you know, in terms of estate planning, you know, people think a lot about, you know, how do I make sure that my assets pass on with as little taxes as possible? That's part of estate planning as well. And then, you know, there's property transfer tax exemptions that you might be available to. So if you pass that property on to the next generation, but you were also occupying that property as your principal residence, then there is an exemption when you pass it on to your beneficiaries. But it also depends on who your beneficiaries are. Right? So you can't be passing it on to your siblings, right? Because that will trigger property transfer taxes. But if you pass it on to your children, there's usually an exemption for that as well.
Oh, interesting.
Yeah.
Would it pay to have like your child on title? Like, would that be a smoother process? Do you know, or?
Yeah, it might. You know, if you have them on title, then you have to think about whether or not they're on title purely for the estate planning purposes, or if they are on title because they are truly a partner with you in this property, like they have beneficial ownership, right? And where they are on title but they don't have beneficial ownership, you have in effect what is a trust relationship there, because they and you are legal owners of the property, but the property doesn't belong to them yet. It still belongs to you beneficially. So then you have effectively a trust relationship, and that will impose additional obligations in terms of trust returns and whatnot as well too. Yeah.
All right, let's play a game. So my kids like to play this game at Christmas time called Will It Stick? And they throw random things at a Christmas tree to see if it sticks.
All right.
So let's play Will It Pass the CRA
Does
write
it
off?
stink?
Does it stink?
All right,
let's
does it
play
stink?
that game.
Okay.
Okay, number one, car wash.
Yeah, it smells pretty good, just like your car wash.
Yeah.
Probably put it under repairs and maintenance of your vehicle.
Okay. Okay, what about like looking fine, like clothing?
Uh,
I got to get a nice watch, a new bag.
Sure, you look great, but it doesn't smell good, right? No, it doesn't smell good. CRA's position on that is that if you can wear a particular outfit for a non-business purpose,
Okay.
then they're going to treat that as non-deductible. That also extends to dry cleaning as well, too, right? So it's probably easier to think about what is deductible, and that would be things like safety wear. So if we're surrounded by construction sites,
Right.
if you're a construction worker and you have like those bright fluorescent vests, that would be tax deductible. That would be fine, right?
Okay.
When you guys go, if you work in pre-sales and you're taking clients in to do site inspections or whatever, that would be okay too.
Okay,
right?
so I'll just wear safety equipment every day.
Everywhere, bright fluorescent vests.
For the tax benefits.
Yeah.
Okay.
How about like client gifts? Like so if like if you want to give gift cards or like even a cash client gift, does that?
Yeah, so client gifts are tax deductible. I don't have a problem with that. It really kind of depends on what you're giving though, because you still want to have some sort of paper trail.
Okay.
So if you're giving them a cash gift, that's a lot harder to track. If you're giving them a cash gift, but in the form of a check, that check's going to clear your account. You've got a name, you got a check image. It's a lot easier to track. And if you decide to give gift cards, you might want to make a list of who you're giving the gift cards to. And then even the type of gift card that you're giving matters as well. So if you're giving it to a location that is a restaurant, coffee shop, BC liquor store or whatever, that still falls under meals and entertainment, which of course is subject to a 50% deduction limit. Or you can give them a gift card to Canadian Tire, Costco, Home Depot, whatever.
Right.
Your clients are buying and selling a home, they're probably going to do something at Home Depot, and that would be another way to show them some appreciation.
Right.
And that expense for you would still be 100% tax deductible. Right.
Now, what about if you were to take them to like a Canucks game or a sports game or something like that?
So generally speaking, that would be tax deductible, right? Depends as well if we're talking about a single game versus a season ticket type thing. So season tickets, the Canada Revenue Agency considers that to be more like membership fees, that falls in line with things like gym club dues, social club dues, golf club dues. So if you are buying a whole block, be it a quarter, half, or full season tickets, then that would be considered non-deductible for income tax purposes.
Okay.
Whereas if you buy a single ticket to a single event, that would still fall under your meals and entertainment, subject to a 50% deduction limit.
Okay. What about like decor for my home office?
Oh, for your home office?
Yeah.
Oh, I don't know. I'm not sure if that smells really good. I think it might stink. Only because when we think about your home office, I think of it more as primarily your place of residence. Right. And I don't necessarily want to be deducting too many things related to the place that you also call home, because we don't necessarily want to jeopardize your principal residence exemption, right? Okay. But, if you buy decor for your office at the brokerage, I would say that's fine, right?
Okay. What about filming a podcast episode?
Based on what I see around me, you guys got a great setup here. Yeah, I would say that's tax deductible. Why would it not be, right? Yeah.
All right, Jamie, so people are going to have questions about this tax things, and I don't want them to come to me. So how can we find you? Are you on social media, or where are you at?
Yeah, I'm terrible with social media. You won't find me there. I mean, I'm there, but I'm not really there. So, you definitely don't want your accountant on social media. You want your accountant doing your taxes. Right, exactly. So they can find me by way of sending me an email, for example, or they can go to my website. It's jltcpa.ca. And if they're going to reach out to me, it's really important that they let me know they're your clients, right? So, hi, I'm clients of Tyson and Mary Tess. That helps me to weed out, the
randos,
random people, right?
Well, yeah, that's one of the benefits of clients working with us is that they get access to resources like Jimmy.
Absolutely.
Yeah, for tax advice. So that's great. Well, thank you so much for being on the show today. And really appreciate your time.
Oh, thank you very much for having me.